All right, everyone. Good morning and welcome to the penultimate BEM seminar for fall 2020. And today we are pleased to have with us Mike Young from University of Missouri, who will be presenting his paper on the Phantom of the Opera, ETF shorting and shareholder voting. As a reminder, if you have questions, please free to put them into the chat box and I will aggregate them and ask them in batches. Additionally, I believe Rich Evans will also be monitoring the chat and may type in replies. I'm going to go ahead and turn the floor over to Mike. Mike, the floor is yours.
All right, thanks, Vigata, and thanks to Vickers and Kevin and everyone else for inviting us on the program. We're right in the end stages of kind of doing a final revision on the paper, so any comments we get right now will be extremely helpful. And for anyone who really enjoys the title Phantom of the Opera, send a note to Oguzhan. That was his, he was the brainchild of that, so I think he really enjoys the title of this paper. But just to get started, so as Sugata said, Rich is on the call, and so is Oguzhan, and Rabi Moussaoui from Villanova is joint work on this as well. So we've always started this talk, and I think the best way to start is with this quote from John Bogle in the Wall Street Journal, late 2018, talking about indexing and its implications on corporate governance. So he goes on to say that most observers expect that the share of corporate ownership by index funds will continue to grow over the next decade. The big three, so BlackRock, Vanguard, and State Street, might own 30% or more of the US stock market, effective control. And as he says, I do not believe that such concentration would serve the national interest. So this is the founder of modern index funds saying maybe the only negative thing he's ever said about the product. When someone like this says something, this grave, then we do need to take note and see what's going on and see what these implications are. So I think most people probably in the chat know or on the call that passive assets have grown substantially over the past decade. They now exceed $16 trillion globally. As of September of last year, passive mutual funds plus ETFs now exceed active mutual funds in terms of assets. And inside of these passive assets, ETFs are the fastest growing vehicle, and they now represent roughly 30% of the dollar volume of US trading. And so with that, there's been this kind of growing literature and this argument of, what is the implication of passive investing on governance? So there's an argument that passive is good for governance. And part of that stems from this incentive structure that with providing quality governance leads to better returns, larger TNAs, which leads to more fees for a passive product. Additionally, without exit, voice is enhanced for these passive managers. And then in general, more passive ownership increases institutional attention, which is going to enhance governance. But on the flip side, there's this argument that passive investment is bad for governance, that to use this enhanced voice effectively really requires firm-specific knowledge and not a one-size-fits-all approach that most people would associate with a passive product. Finally, passive managers, they track indices and minimize costs, but again, using this active, effective voice requires costly effort and doesn't result in the alpha for a passive product. So there's this open and very important question of, do passive investors vote effectively? And now I've said all that on that slide, and what I'm actually going to say now is we believe before we can even ask whether they vote effectively, we need to ask what we think is a more foundational question. And that is, do ETFs themselves indirectly limit the voting in their underlying stocks? And I want to be very clear here that I'm not going to argue that ETF sponsors are not voting their shares. So this paper is not about the possibility that Vanguard owns 10 million shares of Microsoft and they're not voting some or all of those shares. But what we are going to say that there's an unintended consequence in ETF security design, and this leads shares of the underlying stocks that would have otherwise been voted to be held in collateral accounts that are then sidelined from the voting process. So this is going to occur during when there's lending or directional short selling of ETFs, or after what is called operational shorting of ETFs. And for those of you not familiar with the operational shorting, I will kind of get into that a little bit later, but it's part of the liquidity mechanism in the ETF markets. So what is our contribution? We are going to introduce this novel measure of ETF phantom shares and underlying phantom shares. For the presentation going forward, I'll just refer to the underlying phantom shares as phantom shares for short. We're going to examine the impact of these phantom shares on proxy voting, and we're going to test whether this loss of voting rights of phantom shares is priced using the vote premium measure developed by Oguzhan and his co-authors in their 2014 paper. So to get a sense of, what's the size of this loss in voting rights and how can we quantify it? A simple back of the envelope calculation. If you invest $1 into an average index mutual fund, that translates to about 98 cents worth of voting rights. But if we invest $1 into an average ETF, it only translates into roughly 85 cents with voting rights. So that gulf or that decoupling is what we're going to focus on in our paper. All right, and so Bogle in the same editorial, he starts discussing possible solutions. And while doing so, he actually unintentionally describes almost the exact issue that we find with ETFs. So he goes on to say that what we could do is limit the voting power of corporate shares held by index managers, but such a step would in substance transfer the voting rights from corporate stock owners who care about the long term of the firm to corporate stock renters who do not. As he says, this is an absurd outcome. And so this is kind of what we find in our paper as well. All right, so before I go on, and I'm going to talk a lot about the mechanism kind of going forward in the next few slides, I think it's important to point out some of the major differences between ETFs and index funds. I know a lot of people in here probably know a lot of this stuff, but there's one very important point I think we need to make. So like most people know, is ETF is going to be this hybrid between a stock and a mutual fund. Like a fund, it's going to track an index, but like a stock, it's going to be priced and trade intradaily. But for our paper and our mechanism, the primary difference, and it can be very important between ETFs and index funds, is this secondary market liquidity provision mechanism where these ETF shares are created and redeemed, and these authorized participants who are generally market makers, broker dealers, or large institutional investors, they're going to play a really essential role in providing liquidity to this market.
Hey, Mike, there's a quick clarifying question from David Brown about the previous slide. Does that imply that ETF voting rights are worth at least 15% of the value of a share, or that you only get 85% of your voting rights?
Does it imply that ETF value 15% of a share? It is, so we'll get into that a little bit. It's more so it's when you buy an ETF, you have, I think the easiest way to put it this way, when you buy an ETF in a secondary market, you have an 85% chance of buying an ETF share that conveys full voting rights, and then a 15% chance of buying an ETF that is phantom, that is backed by collateral that conveys no voting rights. Does that hopefully make that a little more clear?
Yeah.
And I'll think that we'll, as we get through that, I'll hopefully make that a little bit more clear when we talk about the mechanism. All right, so like I said here, the biggest difference that we're going to focus on is where you purchase an ETF from. So we're purchasing an ETF from a secondary market, like I just mentioned, versus an index fund where you're purchasing it from an investment advisor, and that's going to be an important factor as we go forward. All right, so the previous question actually kind of led to where we're getting at, and I'm going to spend a lot of time in this mechanism because it is fairly new, but this slide I think is hopefully going to clear things up rather quickly. So the way to think about this loss in voting rights that we think is the easiest is to look at stock, a mutual fund, and an ETF and compare the voting rights of $1 invested in each. So if we start on the screen's left, if we invest $1 into a stock, the voting rights are very simple. My broker is going to hold those shares, and I'm going to direct my broker to vote the shares in the direction that I please. So the $1 I invest in the stock is going to translate into $1 of voting rights. It's very simple. Now, once we move to a mutual fund, I'm going to give my $1 to Vanguard, and that mutual fund is going to be backed by a portfolio. It's going to be made up of roughly 2 cents of cash to account for daily redemptions and 98 cents of stock. And so the investment advisor or Vanguard is going to hold those 98 cents worth of stocks, and they're going to vote on my behalf. So the $1 I invested into the mutual fund is going to translate into 98 cents with voting rights. So now getting to the ETF, and like I mentioned here, it can be this hybrid between the stock and the mutual fund. So you don't, because you're buying on a secondary market, you don't know who you're buying your ETF share from. And 86.7% of the time, roughly, let's say 87% of the time, you're going to be buying your ETF share from someone who owns those shares. So we call this a long sale. And that's going to act exactly like an index fund. That ETF is going to be backed by the same type of portfolio, 98 cents of stock and 2 cents of cash. So that's going to where we get this 85 cents of voting rights. But the other 13.3% of the time, you're going to be buying from a short seller or a market maker. And in these cases, the ETF share is not backed by the underlying portfolio. It's going to be backed by collateral. And this collateral might be cash or some cash plus a futures overlay, in which case it wouldn't have any effect on proxy voting outcomes. But a lot of times the collateral is actually going to be some representative portion of the basket or some type of stock. So what happens in this case is this ETF share is then backed by this collateral pool, which because of broker voting rights are not allowed to vote in proxy meetings. So that's where this loss in voting rights comes from. By the short selling of these ETF shares, stocks that would have otherwise been voted are pulled into collateral pools, and because of broker voting, they can no longer vote those shares of stock. So that's where, in a kind of simplified terms, this loss in voting rights comes from. All right. So now I'm going to get into, I talked about directional shorting and kind of lending and hedging purposes. I'll go through an example of that and then talk about operational shorting as well. So here's a very simple example. Let's say I'm ETF investor 1. I go out in the market and I buy a share of SPY. Now this share is going to be backed by the underlying security. It's going to be held by State Street, and State Street is going to vote those shares. And my ETF share is going to be held by my broker Fidelity. So this is very straightforward, just like the voting rights are just like a mutual fund.
Hey, Mike, there's a question.
Yeah.
So Sophie Shive asks, using the same reasoning you used, I guess, on the previous slide, are we concerned that derivatives don't come with voting rights?
So I don't think that, derivatives themselves, it would be the underlying that would convey the voting rights. It depends on, so really the mechanism here is if anything happens that these shares are being held as collateral, then they can no longer be voted. So whatever's going on, if you're making some type of derivatives trade, if you're using as a hedge some type of stock, once that stock is placed in collateral, it can no longer be voted. So I think that's how the voting rights would work. I'm not 100% sure with the derivatives that precisely, but I think that's the way it would work in that instance.
Okay, Sophie, thanks you for that answer. Travis Box asks, why would this be any different than short sales from market making in the underlying securities? Aren't they still broker held?
So they are. I think that one of the main differences here is that when you're dealing with an ETF rather than just the direct security, that once you buy an ETF, you don't get the voting rights directly. Their voting rights are come through the ownership of the underlying shares. And we talked about this a little bit in the paper, but the issue with voting and short selling of share lending, that a lot of that was kind of fixed by kind of the early literature that talked about overvoting and undervoting with respect to share lending. But with these ETFs, it's going to be mostly how these shares are held. And I guess if the shares are held by the market makers, then I guess it might be a similar effect. I'm not 100% sure on that, but I think Rich might know a little bit better about outside of the ETF space and kind of the market makers, how that would work.
It's a really good question. I'll just add my 2 cents here. So it's no different. In fact, we're going to show you a little bit later that although we're describing it here in terms of, an outside arbitrager, hedge fund, et cetera, that most of our result is actually driven by what we call operational shorting in a different paper. So yes, there's no question about it. That's important. That's actually driving most of our result, is this process of market making for the ETF, where the AP/market makers holding the underlying securities, when they hold them as collateral for, possibly extending themselves, an operational short of the ETF, those shares are not voted either. So yes, it's the same thing. And we're going to show you that drives most of our results. It's operational shorting, not directional shorting of ETFs, that is giving rise to what we find here.
All right, thanks, Rich. Hopefully that clears up kind of the share lending. Earl, kind of get through this. So I had started with this kind of very straightforward example, but now if we work in this share lending example, let's say Goldman Sachs comes along, and who up until recently was the securities lending agent for Fidelity. They said, we need to borrow this share for a short seller. And once this goes through and the short seller then sells the share again back into the secondary market, we've created what is called a phantom ETF share. And I'm going to use Sugata in my example. Let's say Sugata is ETF investor 2. And that short seller has sold this phantom share of SPY to Sugata. So now I have a share of SPY, so does Sugata. We both have the same cash flow rights. We can buy and sell whenever we want. We have the rights to the price appreciation. But as a part of this lending agreement, Sugata's share is backed by this collateral, which is possibly the underlying, is going to be held by the securities lender or the broker. And again, because of these voting rules, they do not vote those shares. So that's where the difference comes in this decoupling occurs, is that my ETF shares conveys full cash flow rights and full voting rights, but Sugata's only conveys the cash flow rights. Right. So we have talked a lot about this possibility that if these shares of the underlying companies are held as collateral, are they being voted, or how are they being voted? So to get at this, we found that the European Securities and Markets Authority was fact-finding for possible rulemaking and asked the institutional market participants almost the exact question we would ask them as well. So it was very nice to find this particular survey. They said, what kind of internal policies, if any, do you have governing the exercise of voting rights in respect of securities held as collateral or as a hedge against positions with another counterparty? So again, this is the ideal question that we wanted to ask for the situation that we think is going on. So the answers were very straightforward. That first, the International Securities Lending Association answered, an ad hoc survey of lenders confirmed that lenders have not nor would ever exercise any voting rights in respect of securities held as collateral. The majority of written governance policies are worded specifically to exclude the voting of collateral. And JP Morgan, in a similar vein, said, quote, we have a separate internal policy to abstain from voting in most instances of hedge trading positions. So again, this is very clear from these market participants, is that if these shares are being held in collateral, they are not, the voting rights are not being exercised. So this is where, again, this loss would occur. All right, so Rich touched on a little bit the operational shorting, and I spent some time getting into that because, as he said, later on in the presentation, we will show that much of our results, or all of our results, are being driven by this mechanism. And to start explaining this, you might be wondering, why is he showing a picture of Twinkies, some of which are dressed up as minions? But to get at this, I think it's an easy example that conveys into the way the ETF market works, and we call this the Twinkie arbitrage. And so I will let you, for yourself, believe how true the background to the story is that I will tell, but hopefully it conveys the right message. So when I was a kid growing up, most kids when they're 10 or 11, they want to be astronauts or, let's say, professional athletes. And I thought to myself, being a millionaire, being a professional athlete, and being famous sounds super boring. I want to be a finance academic. So when I was 10, 11 years old, I was always looking for kind of these ways to make some money. I'm always looking for a good deal. So I'd go to lunch during elementary school, and I would notice that the kids I'm eating with, their parents are giving them celery and broccoli and carrots. And, I was once 11, you guys are once 11. You probably don't really want to eat that for lunch. You probably want to eat some, good sugary snacks. So I figured what I can do is I can go to the store, buy a box of Twinkies for $3. And at my school, for all these kids who are craving their sugar at lunchtime, I can sell them Twinkies for 50 cents a Twinkie. So again, as I said, myself is pushing away the future stardom of a professional career. I found a nice little arbitrage strategy and very simple profits. I can buy this box. The box is cheap. The individual components are expensive. So I'm going to open the box and sell these individual Twinkies. So again, the profit's very clear. $3 for the box, 10 Twinkies times 50 cents each. I make $2 every time I do this. There was one issue, however, is I myself was also a young kid craving sugar, and you wouldn't be a good salesman unless you tested your own product. So let's say there was some inventory loss along the way, and we only ended up with 9 Twinkies and a $1.50 product, right? $1.50 in profit. But let's say the other way, something else happens. People follow my lead. They're like, oh, Mike has a good idea. I'm going to start selling Twinkies on the elementary school market too. So now the price of Twinkies crash. What I can do is go back, buy them, put them back in the box, glue them up very nice, and sell them back to the grocery store. So we all know this really can't happen. It's kind of a crazy example, but it is useful because it's actually the exact way that these authorized participants work in ETF markets and perform this arbitrage between the market price of the ETF, what meaning you can buy it for, and the basket NAV, the valuated price of all these securities. So this example here with SPY was, I think the slide was made about a year ago, but it's the same thing going on here. The market price of SPY is cheap. The box, the ETF is $275. The components are expensive. The basket, the valuated NAV is $276. So I have a very clear arbitrage strategy and profits. I'm going to buy the ETF and sell the basket of stocks. And you can see the profit here below. And in the reverse case, the same thing can happen. Let's say the underlying securities become cheap and the ETF becomes expensive. I can sell the ETF and then buy the securities later. Now, the one thing that's important to note about this profit function here is that we can't do this for one ETF at a time. We need to do this for a creation unit. So you can see that the profit is driven by the creation unit size. And in general, APs create ETFs at about 50,000 shares per basket. It can vary a little bit, but on average, the creation unit for an ETF is about 50,000 ETF shares. So this is how this AP arbitrage works. They can go in and ensure that there's liquidity in the market and that the price and the NAV do not vary too much. And so here's where these APs are sitting in the market. In the primary market, they can create and redeem shares with the ETF provider and have these in-kind transfers. In the secondary market, they can make markets in the ETF, but they are also authorized to come in and provide liquidity when necessary. So if there's excess demand for the ETF, the example I just talked about where the ETF share is expensive and the basket is cheap, they can come in and sell ETF shares to provide liquidity from the market. And this is where this operational shorting is going to occur. But the case in when we generally think of an arbitrage opportunity, we're buying and selling at roughly the same time to lock in that profit. But the way operational shorting arises is these APs will come in, they meet demand in the secondary market by selling ETF shares. But what they found they can do is they argue it as a predictable return by they sell these ETF shares to meet demand, but they delay purchase of the underlying securities. And they are allowed to do this through these ETF market making rules. So what these APs do, they come in, they sell ETF shares into the market, but they don't fulfill the underlying basket until a later date. So this is where the loss in voting rights is going to occur for these ETF shares, because instead of being held backed by the underlying securities, these shares are again going to be hopefully backed by the AP's assets. So it might be a cash plus some S&P 500 futures overlay, or again, it might be some representative underlying securities that are kind of a collateral or a hedge against the operational short position the AP has created by selling the ETF share, but not fulfilling the underlying basket. All right. So hopefully that is somewhat clear for people. These two different mechanisms we think might be going on, and then we'll later test between the two of them because there are some important implications for which drives our results. So that is a lot on the underlying mechanism of what is going on here. And now it's going to go through an actual example we see in our data. So if you're familiar with the ETF kind of research or ETF markets, you might be familiar with an ETF called XRT. It's a retail ETF. and we're going to go through its ownership of a firm called Shutterfly. So at the end of March 2011, if you go into the 13F filings, you'll see that there's 123 million shares of Shutterfly that are owned. And again, this is going to be a lower bound because small and retail investors aren't going to file. This is roughly 6.2 billion in TNA. So XRT holds a company called Shutterfly. It's about 1.4% of the ETF. And Shutterfly had a proxy meeting or a vote date on June 3rd, for which the record date is April 5th. And I want to make a point here to mention that when we're creating this phantom share measure, we're going to create it at the record date, which is always going to be 1 or 2 months before the actual meeting date. So there's going to be some kind of time disconnect when we're creating our measure and when the outcome of the meeting date actually occurs. So on the record date, XRT held roughly $90 million worth of Shutterfly, which translates to 1.7 million shares of Shutterfly that were owned by XRT. So we can then go in and see, well, how many shares of Shutterfly did XRT vote at that company meeting? It turns out they only voted 66,000 shares, which I think begs a very obvious question of, well, why didn't those other Shutterfly shares get voted? To answer this question, what we're going to do is go into the short interest ratio of XRT and look at it on that same date, March 31st, 2011. And we'll find that the short interest ratio at that date was 736%. So once you go into CRSP or Bloomberg, you'll see that the actual number of shares created and in existence of XRT is only 19.8 million, but this short interest ratio is actually implies that on average, each of these shares has been lent out 8 different times. So instead of that example that I gave where I was ETF investor 1 and Sugata was ETF investor 2, there's now ETF investor 3, 4, 5, 6, 7, 8, 9, going higher and higher. So actually, there's 165 million shares outstanding of XRT, 19.8 million of which are going to be backed by the underlying securities. They're going to be held by third-party custodian and voted by the sponsor. So these 19.8 million are going to act just like index fund shares. But the remaining 145 million that might arise again from operational shorting or the share lending are going to be backed by collateral, held by a security lender or an AP or a market maker. So to create our measure, so if we look at the TNA of XRT, its holdings of Shutterfly, these 19.8 million shares are going to translate into 275,000 shares of Shutterfly that are owned by XRT that they should be able to vote at the company meeting. As a side note, we're going to ignore share lending for this purpose. So this 274,000 would be the upper bound. The 66,000 shares they voted might be due to the fact that they are lending, that XRT is lending some of these shares of Shutterfly out. But then the 145 million shares that are backed by collateral are going to translate into 2 million phantom shares of Shutterfly that we would assume are held in collateral accounts and can't be voted. So once we've done this process for XRT and its ownership of Shutterfly, we're going to repeat this process again for each ETF that also owns Shutterfly. So this is how it's going to look. And you can see that the ETF shares in the first column are going to be what have voting rights and the underlying, and then the phantom shares are going to be the shares of the underlying that are likely to be held in collateral accounts and may not be voted. All right. And then, so obvious point, we are going to, once we've done this for XRT or for Shutterfly, we're going to repeat this process for every firm in our sample.
Mike, David Brown has a question.
Yeah.
How do 145 million shares translate to about 2 million?
So that is based on the ownership. So that's 145 million shares of XRT are going to translate into, so based on the TNA, the holdings and the price of Shutterfly are going to translate into those shares. So it's 145 million ETF shares translates into 2 million shares of Shutterfly. It should be, hold on. I think I see his question there. 19.8. Let me see this. I think that should make sense, right? Sorry. I want to see something here.
I think the simple answer is
Dollar.
Shutterfly is a tiny percentage. It's
Yeah.
1.4% of the overall thing, right? So
Yeah. Yeah, that's right. Okay. All right.
Okay,
So,
so sort of I have a question, Mike, which
Yeah.
is this seems to me largely an ETF level effect. So XRT, for example, when I buy an ETF of XRT, I'm getting, short, I'm not getting the full voting rights.
Yeah.
This doesn't seem to be a company level effect. So for example, Shutterfly, every share of Shutterfly out there still has a vote. Like the whole, like anyone who's holding a share of Shutterfly is not affected. This is an ETF level effect. Why are we now taking this to the company level?
So I think that, so the point there is, Scott, I think that's a really good question to hopefully clarify this is, so yes, the phantom shares are being generated by the ETF shorting, but and every vote of every person who owns a share of Shutterfly does still have voting rights. But as part of this collateral, shares of Shutterfly that would have otherwise been voted are pulled from the general voting pool, posted as collateral, and then because of rules on broker voting, they're no longer being allowed to vote. So what we're doing is through this process of either directional shorting, lending of ETF shares, or operational shorting, we're pulling shares of Shutterfly out of the possible voting pool. They're being placed in collateral, which can no longer be voted. So it ends up being a firm effect that is driven by short selling at the ETF level.
But hang on, Mike. I mean, in your previous slide, sort of the majority of the effect was driven by this 736% short ratio of XRT.
Yeah.
And at the bottom, you said, we're going to ignore the fact that some of these 274,000 shares are being lent out. And now, like, it seems like the real effect that you're talking about here is this 8 times multiplier of XRT, rather than the fact that some of the few actual shares that are held by XRT are actually being lent out.
So yes, we are, ignoring the share lending. And I think that's a topic for a different paper. One thing I will mention here is that XRT is the far, far right tail of the distribution of short interest ratio on ETFs. So many of them are not going to have short interest ratios of 800%. So XRT in this case would dominate for Shutterfly, but in many other instances, like you can see on the next slide, that the short interest ratios are generally much lower. So in the second row here for this Russell 2000 index, the short interest ratio is roughly 100%. Some other ETFs, for the growth index, it's much lower. So it is going to vary across. And I think, so I mentioned the share lending only to kind of figure out why the gap between the 66,000 and 275,000 shares are there. But I think it's an issue aside from our issue that we find. And this does end up still being a firm level effect because it's translating these phantom shares are phantom shares of the underlying that are, they still do have the voting rights, but because of where they are held in these collateral accounts, they can't be voted. So I hope that, kind of push back a little bit on that this is an ETF effect. We do think the effect is driven by short selling in ETFs, but it is a firm level effect. Even though on this example I'm giving, much of the phantom shares are driven by this one ETF. This is a massive outlier in terms of the size of short interest or the amount of short interest of XRT. Most ETFs are not at this level.
Okay, so David Brown follows up with, how can there be more phantom shares than the ETF actually holds? Does that mean someone else outside of the ETF has lost their voting rights?
So there can be more phantom shares than the ETF actually owns if this short interest ratio gets large enough. And in fact, if once it gets over 100%, then you will see that through the share lending process, the shorting process, or operational shorting, that more ETF shares have been created than actually have been where the underlying shares have been delivered. So if there's a lot of lending going on, these shares are being lent over and over again, then there's going to be more ETF shares out there than have actually been created and are held by the sponsor. And the same with operational shorting. If there's a lot of excess demand and APs have come in to meet that demand by selling ETF shares but not fulfilling the underlying, then again, we can have a case where there are more shares of XRT that are owned that are backed by collateral than there are that are backed by the underlying securities. So nobody who owns a share of Shutterfly has lost their voting rights unless, as a part of this hedge or lending, has posted it as collateral. So that's where this loss in voting rights comes from. And I hope that makes it clear how we can have more phantom shares than there are actually shares owned by the ETF. And that just, if the short interest ratio or the short selling or lending becomes large enough, that's how that can occur. Okay, so just a quick overview of the sample. So we're looking at US equity ETFs from 2004 to 2018. We're not going to get into this too deeply, but we use shares outstanding from Bloomberg, CRSP, and Morningstar. They vary a little bit, so we use the one that's most accurate. CRSP for price and trading volume, holdings in CRSP, NPX voting data, biweekly short interest from CompuStat, and then governance data is going to come from ISS. We have a test later on using securities lending data from Market, and all of our regressions are going to include firm fixed effects, and standard errors are going to be clustered by firm and meeting. All right, so looking at the size of ETF ownership with quick summary stats. Over the course of our entire sample, we see that ETFs own roughly 3.5% of firms. Now, this is going to increase over the course of our sample, especially from 2004 to 2018. The size of the ETF market has grown dramatically. Same with phantom shares. On average, they're about 60 basis points of their firm shares outstanding. It's going to grow over time. It's also going to grow in the cross-section of firms. If we do a Russell 1000, 2000 split, for Russell 2000 firms, this average is actually closer to 9 basis points or 1% of shares outstanding. So again, it is going to grow based on the firm you look at or as the size of the ETF markets continue to expand over time. All right, so looking at our first result, we're going to look at, on the left-hand side, votes for, against, and broker non-votes. These are all going to be scaled by potential votes outstanding taken from ISS. And in these first two columns, we are going to find, consistent with this distortion in voting and the loss of voting rights, that an increase in phantom shares is going to lead to a decrease in both votes for and against agenda items. So each observation in this table is going to be a firm meeting agenda item, and we're going to exclude director elections, the ratification of auditors, and votes requiring a 1% pass level. And in column 3, if these shares are being held as in collateral and brokers are not allowed to vote these shares, we would expect to see an increase in broker non-votes with an increase in phantom shares, and that is exactly what we find here. So that's kind of our first result. We are seeing less votes for and against, an increase in broker non-votes, so as a sign of this distortion in the voting process. Now, it might be the case that what we're actually picking up is some type of concurrent trend in voting and the growth of ETFs. But what we can use here is the change to broker voting rules. So the SEC allows brokers to vote their shares uninstructed on all routine items, but does not allow them to vote their shares for non-routine items. And as this definition has changed over time, we're going to exploit these discrete changes in broker voting rights to really further examine the effect of phantom shares. So we have two major changes that we're going to take advantage of. The first of which starts in January of 2010, and that was a shift in the classification of director elections from routine prior to that date to non-routine after 2010. So prior to 2010, directors or brokers could vote their shares. After 2010, they could no longer vote their shares. There was a similar rule change in 2012 that reclassified many governance-related items as non-routine, and this affected items to destagger the board, implement majority voting, or eliminate supermajority, and so on and so forth. So we're going to use that as a discrete change in the broker voting rights. So in column 3, looking at just a sample of director elections from 2008 to 2012, so a small window around that rule change, what we find is what we would expect if this is being driven through this broker voting rights. Prior to 2010, we don't see any effect of phantom shares. So it does seem like brokers were widely voting those shares. But after 2010, when brokers could no longer exercise those voting rights of their shares, that's when we see this positive increase of broker non-votes from phantom shares. In columns 4 through 6, we see the same thing. So in 2012, specifically for these governance-related items, once brokers were no longer allowed to vote their shares, that's when we see this positive effect of phantom shares on broker non-votes. So I think that's a nice test to use these discrete changes in broker voting rights. All right. I've talked a lot about this collateral channel and shares being held as collateral can't be voted. So what we're going to do here is try and proxy or find some proxy for the likelihood that a stock as part of this short selling or part of operational shorting will be posted as collateral. And the idea we're going to use here is that the best hedge against the price movement of the ETF is going to be a stock that has the highest correlation between its return and all of the ETFs that hold it. So our measure is going to be to calculate the value-weighted correlation between each stock and every ETF that holds it. And then we're going to use a rank of this correlation. And that's going to be the control for differences in the number of constituents. So the correlation between a stock and an ETF in an ETF that holds 100 stocks versus 2,000 is going to be artificially higher. And then the rank is going to control for that. So again, here it is. The higher the correlation, the more likely we think it's going to be held as collateral because it provides a better hedge against the price movement of the ETF. So in column 1, this is what we're going to find. So once we interact this value-weighted correlation between the stock and all of the ETFs that hold it, the stocks with a higher correlation are the ones that are going to see larger increases in broker non-votes. In column 2, we see this again using an equal weighted correlation. And in columns 3 and 4, we use a decile just to ensure that it's likely that it's not small changes in this correlation that's going to be driving this decision. It might be more larger decision or larger changes. So that's what the deciles might pick up. And we find the same result. So this is a nice result in the sense that we've talked about this collateral channel, and we think this is good, solid evidence that these shares that are more likely to be posted as collateral as a part of these transactions are the ones that are causing the largest increase in broker non-votes. And so earlier on, we touched on this result earlier, but there is this difference between directional and operational shorting. And now instead of using our phantom shares measure in general, we're going to try and split those two apart. So again, this directional shorting phantom shares measure is going to arise from borrowing of ETF shares to sell for speculative or hedging purposes, whereas the operational shorting is going to be done by APs purely for liquidity decisions, going to sell ETF shares that have not been created in the markets. So to create the directional phantom shares, we're going to use shares on loan data from market, and our operational measure, our operational phantom share measure is going to be the difference between the overall phantom shares and the directional phantom shares. So here what we find is that, Rich had mentioned this earlier, but the increase in broker non-votes is going to be largely driven, or almost all driven, by these operational phantom shares. So you column 1, by itself, we see a very strong and positive relationship. In column 2, we don't see any relationship with these directional phantom shares. Putting them together in the same regression, we again find that the operational phantom shares are going to dominate. And we think this is a really important result for this reason. If our results were only being driven by these directional phantom shares, then there might be an argument that what we're finding is just more information being incorporated into the market, that these informed short sellers are going out and that is driving our results. But because, as in Rich and Robbie and their co-authors' papers, they show that this AP operational shorting is purely for liquidity reasons and has no effect on the underlying shares themselves. So this is a nice result that really, we hope, insulates us from any type of alternate explanation of what might be causing the change in voting.
Mike Vikas asks, is this loss in voting rights material? Does it matter for corporate governance?
So I think that is a great question, and I'm going to spend the rest of my time trying to show you that we think it does. So we have some, I'm going to touch on some pass-fail results that we think, so they do affect the pass and the passing of certain items, and they're actually going to affect merger returns as well. So that's what the second half of our paper is going to try and show, is the real effects of these phantom shares. So I think that's a great question and leading me right into my next slide. So to kind of reiterate Vickers' point is, the question still remains, yes, there is some distortion in the voting process, but is there any real material impact of these phantom shares on voting outcomes? So I think the first place to start is the past probability of certain proposals. And what we're going to make one slight change here, and we have this ability to assign the hypothetical vote of phantom shares based on the vote of the ETF. So the way to think about this is, if the ETF was actually an index mutual fund, this is how the shares would have been voted. So we're going to create measures called phantom shares voted for and phantom shares voted against. And so a phantom share voted for is a phantom share that are derived from an ETF that voted for the item, and a phantom share voted against is a phantom share that was derived from an ETF that voted against that item. So the phantom share voted for are going to be shelved for votes, and the phantom shares voted against are going to be shelved against votes. They would have otherwise been voted for, but they can't due to the collateral voting rules. So we're going to look at shareholder proposals, close votes, again, reuse that exogenous change in broker voting rights, and then we're going to have a really nice test on the voting base of the item that I'll kind of touch on a little bit more. So in column 1, we're going to look at shareholder proposals. Just to note that this is a logit with odds ratios as coefficients. So less than 1 means it's less likely to pass, and more than 1 means it's more likely to pass. So what we find here is that these phantom shares voted for, again, these shelved for votes, make these shareholder proposals much less likely to pass, and these shelved against votes means the shareholder proposals are more likely to pass. So on these shareholder proposals, which have been shown to be important, we are seeing real effects of these phantom shares. Again, in close votes, these are close votes of 5%. We are finding the same result, that these phantom shares voted for that would have otherwise been voted for but are shelved, again, are leading these close votes to be less likely to pass. In column 3, we're going to again take advantage of this nice change in time over the broker voting rights and find that in these important governance items post 2012, we're going to again find that phantom shares are voted for, causing them to be less likely to pass. I'm going to spend a little bit more time in column 4 because we think it's a really nice result. We don't want it to get kind of hidden in the paper. But for some people who aren't as familiar with the voting literature, not all items have the same base to determine the pass rate of the proposal. So sometimes the base is votes for plus against, or for plus against plus abstain, but sometimes it's shares outstanding. And in these cases, it's important to note that a broker non-vote, when the base of the vote is shares outstanding, is going to act as a de facto against vote. And the reason for that is that the share that's held in collateral that the broker can't vote will always be added to the denominator, but can never be added to the numerator. So what we're going to do here is go back to our normal measure of phantom shares, look at these close votes, and identify a dummy variable that takes a value of 1 for any item that has the base as shares outstanding. So here what we're going to find is phantom shares increase, and working through this broker non-vote mechanism, we are going to see that an increase in phantom shares is going to lead to these close votes to be substantially less likely to pass anytime the base of the vote is shares outstanding. So again, this is working directly through that broker non-vote mechanism. We think it's a really nice test without using these signed measures of broker non-votes. So hopefully that's the first step in kind of convincing you that these phantom shares have an effect on corporate governance. The next thing we're going to do is looking at
Mike,
Yeah.
Bob Brooks has a question.
Yeah.
Have you examined if your analysis is related to naked short selling amounts for the ETFs and or the underlying stock?
So with regards to the underlying stock, all of our results control for the short interest supply at the firm level. For the naked short selling of ETFs, I think the previous table of the directional and operational somewhat gets at that. We would hope that during the operational shorting process, the APs are actually using some of their assets to back this as collateral. The directional shorting would be where this naked shorting would probably be more likely to take place, and we don't see any effects there. So I think we've kind of ruled, we haven't directly examined naked shorting, but I think both of those results kind of get at the possibility of either short selling at the firm level or naked shorting of the ETFs.
Mike, can I add just one thing to that? I think it's important to remember too, we're measuring the ETF, the phantom shares 2 months before we measure the actual vote outcome, right? So you'd have to imagine people shorting the ETF and in order to hinder the 1.4% of Shutterfly 2 months later, right? So these measures of phantom shares were calculated 2 months before the vote outcomes that you're observing in this regression.
All right. But yeah, so I think that is another good point that Rich makes. I mentioned it a little bit earlier, but it is important to remember going through this, that there is this time disconnect between when we're measuring phantom shares and the actual outcomes that we're observing. All right, through here. All right. So next thing we're going to do is kind of look at, is this loss in voting rights priced? And to do this, we're going to use, so Oguzhan and his co-authors of 2014 JF paper created this voting premium measure. And the idea behind it is that option prices are going to reflect the cash flow rights of the underlying stock, but they're not going to represent the control rights. So their vote premium measure is the price of the stock, and they're going to subtract the price of a synthetic stock created using options to calculate this vote premium. And the difference between those two is going to represent the difference, the size of the voting, the loss in voting rights or the voting premium. So some of the advantages here are that it's a much larger sample. So other methods of dual stocks have much kind of smaller samples of firms. So this is a nice measure that we can use. This is taken from their paper. And what we do see, what we would expect is in this solid line around special meetings, we do see the value of the vote increase when we think that these special meetings have a larger effect on governance and are more contentious. The value of the vote is increasing and their vote premium measure is increasing along with it. All right, so looking at our measure, we're looking at the vote premium on the left-hand side. Again, this is going to be around the record date. Consistent with their results, as phantom shares increase around special meetings, we are seeing a larger increase in the vote premium. So again, consistent with this loss in voting rights around these contentious meetings. In column 2, we're going to focus on kind of more regular annual meetings and look at the number of critical items. So we're going to define a critical item as a close vote, a vote that ISS opposes, as we know that that drives a lot of fund voting, and any proxy contest. So again, as these number of critical items increase during a regular meeting, we are seeing the voting premium increase with phantom shares as well. So this does seem to be priced in that as this loss of voting rights increases around these more contentious meetings, we do see a larger increase in the vote premium, and we look at different windows in column 3 and 4 and find the same effect. So there does seem to be some pricing going on of this effect.
Hey, Mike.
Yeah.
It seems to be a more direct test of this might be to look at the return to an ETF and the return to a corresponding index fund. The control effect is only there for the ETF. So to compensate, the ETF should have higher returns during these, when the underlying stocks have contentious votes. Have you looked at something like that?
So we haven't. The only thing I think with that is because there's, I mean, I guess you can get away from it, but I mean, maybe I'm not understanding this correctly, but the way, because there's so many firms underlying the ETF, right, and even the index fund, that even if a firm has a contentious meeting and it represents, let's say, 2% of the ETF, there's still a lot of noise going along in the other underlying stocks that might have meetings in different points of the year. But we can definitely think about that. I'll get with Rich and Robbie Novazon and think about how we might be able to kind of use that control or use that test to further look at this effect. But I think that's a good point. We can definitely kind of think about that some more. All right, so the last test that we're going to use is kind of really trying to get a true measure of price impact in the market. And we're going to look at mergers here. So if investors have cash flow rights, but they don't have any associated voting rights, we may expect worse governance for these firms. And so this previous literature has found that negative acquirer returns around the announcement date of a merger is most likely related to poor governance. And this effect is kind of concentrated in mergers with a stock. Additionally, in the kind of the next panel, we're also going to follow up from this Lee et al. 2018 paper and use a 20% share issuance rule to further examine this distortion effect in voting. And so their paper using the share issuance rule, shows that shareholder voting has a positive value in mergers. So I do want to take the time to, so Kylie was generous enough to send us her data so we can use this test. And we think it's a really nice direct test because our effect on mergers should really only be coming through those that require shareholder voting. So we're going to use her variable or their variable to kind of further test this result. So to start off here, we're going to just look at mergers in general and find that our effect seems to be driven or concentrated in mergers that are stock only, which again kind of corresponds to worse governance. Looking at stock only mergers and interacting our phantom shares with the E index, again, we're finding that the acquirer returns become worse as phantom shares increase in firms that have likely worse governance. Finally, putting these all three together in a triple interaction, we again find the same thing, that this distortion seems to be causing worse governance through these negative acquirer returns. All right, like I said in this last test, we think we have a really nice setting because one, we know that these mergers, this above 20 dummy identifies mergers that will require shareholder voting. And we can actually use, in essence, a regression discontinuity design here, because in a stock-only mergers, managers cannot manipulate precisely the percentage of shares outstanding that they issue as part of the merger. So here, if they issue 20% or more of their shares outstanding, these mergers require a shareholder vote. So if there is distortion going on from these phantom shares, we should be seeing it in these mergers that are requiring a shareholder vote. And that is what we see. So across these different settings, so because we have a smaller sample here, it's tough to use the subsamples of different merger weights. So in column one, we're using all of our stock only mergers, and we find about a 3% drop in the announcement returns. In columns 2 and 3, we're going to use a narrow band of only mergers that issued between 5 and 35% of shares outstanding, and then only mergers that issued 10 and 30% of shares outstanding. And then we're going to do that for all public and private firms in columns 4 through 6. But the results are very consistent that when a merger requires shareholder voting, and as phantom shares increase, that is when we see this deterioration in announcement returns. So hopefully, to Vickers' point, does this affect corporate governance with the pass rates, with the voting premium? And I think with these really nice merger results, hopefully we can convince people that these phantom shares do have an effect on corporate governance. And the one thing I would also note is, while these are smaller earlier on our sample, as ETFs continue to grow in size, and as I said early on in my presentation, this is the fastest growing passive vehicle we have. So this issue is only going to continue to grow larger and larger as the size of the ETF market continues to grow. And like we had earlier this year during COVID and during, I guess it was February when the market crashed, once short interest explodes, then we're going to see this phantom share measure increase as well. So just to wrap up a little bit early, so we discover these ETF phantom shares, introduce a novel measure to estimate their magnitude. So we think these phantom shares are costly They do not convey full voting rights to the ETF owners, but they're sold at the full price of a share that is going to reflect both the cash flow and voting rights. They seem to create these inefficiencies within the voting process, and they're positively related to the vote premium, particularly during contentious votes, and they do seem to be priced during merger announcements. And the last regulatory concern that I kind of pointed on earlier, unfortunately we don't have the data to look at how this affects kind of votes around the crash from kind of the COVID. But particularly during times when the market is very bearish or when votes are very valuable, potentially those are correlated. This concern might be very large, and will, again, as I said, will only grow as over time as the ETF market continues to expand. So I think we were kind of early on this and finding this issue as markets continue to rise. So again, appreciate the comments, and Sugata for moderating. If anybody has any questions, feel free to ask them, shoot away.
Wonderful. Thanks, Mike. So we're going to keep the Zoom room open for additional questions and such. I'm going to stop the recording. Thank you, everyone, for showing up. Thank you, Mike. 2 weeks later, we'll have our final VEM seminar for the semester. Sehun Kim will be presenting. We look forward to seeing you all there.
All right, let me stop this.